Hello and welcome back. So, another quarter in 2025. Let's have a look back at Q2 2025. I thought I'll just pull out a few salient points that popped up on my radar and just share them with you. So there's no particular order or preference, but literally just a few talking points. What is actually happening right now in private capital? So let's start off with M&A, jump to buyouts, and then we basically go to venture capital. So globally, M&A activity volume dropped, but deal value rose in the first half of 2025. So total M&A reached about 1.9 trillion. That's about 30% up year on year. So mainly this was driven by a few mega deals. So hence the volume dropped, but deal value is up. So we're about 27% year-on-year increase in M&A deals as it was reported by JP Morgan. They obviously see potentially different deals, especially with the US focus. And we saw a 57% surge in deals above 10 billion. So again, a large surge in very large deals and 72% increase in 1 billion and plus deals. So that basically is a 20-year high. So it's quite interesting to notice that. The largest deal, I should point out, was Charter Communications, buying Cox Communication at $34.5 billion, become America's largest cable TV and broadband provider. So there's more to be said around that, but for those of you dig yourself into the various deals, certainly a space to pay attention to. Now, let's jump to buyouts, because obviously the two of them are very closely connected. And I call it cooling, concentration, and creative deployments. It actually would be a title as well later on for venture capital. Now, in the second quarter of 2025, deal activity was down about 11.5% quarter on quarter, with buyouts down 23% and growth equity, minority investments in fast-growing companies, down 32%, mainly due to tariff uncertainty and rising financing costs. Now, global private equity acquisitions increased more than 40%, again, in terms of value, but count, as we said, was down. Now, obviously, what's interesting everyone is exits. What happened on the exit side? Let's take a look. US buyout exits softened again in Q2 after a strong Q1. You will remember from my last update that Q1 actually looked quite nice and everyone was very positive around that. Obviously, again, the tariffs did not help in that context. And global H1, nevertheless, is still the highest since 2022. So when we go into the buyout space. So again, just to be clear here, when you read sometimes the numbers, it's not always very clear. So I think I put them next to each other. That makes it very, very easy to understand. Global all PE, the first half of 2025, exit liquidity hit a 3-year high. So this is basically with over 300 billion, the highest number of transactions, 250 of them, since 2022. This was mainly led by strategic corporate acquirers capturing over 30% of that share, up from 25% in the first half of 2024. So that again relates to the M&A data I just showed earlier on. Now, US buyouts in the second quarter, 314 exit with 119 billion of value. That is about down 25% in terms of count and 46% in terms of quarter on quarter. Now, this is a flashback. This is a reminder why dry powder actually matters right now. It's not so much the absolute number of dry powder, how much money is there waiting on the sidelines, waiting to be deployed, but it's the aging of the dry powder and see how it's being drawn down, the counterpoint to exits. Now, dry powder, this is a slide from year-end 2024. We will remember, not only did we have quite a lot of dry powder sitting there, we also saw a very large percentage that was reaching 4 to 5 years of maturity. Now, why is that relevant? The investment period in a buyout fund is usually the first 5 years. So the moment your dry powder reaches year 4 and has not been deployed yet, naturally the pressure is on to deploy. So as we can see, dry powder is tapering off and has continued to taper off, to drop off. Nevertheless, we still have that pressure sitting there of dry powder that is old that needs to be deployed. Now let's have a look at secondaries. Again, secondaries remain super active space in the private capital market. They're offering liquidity and DPI for both buyout and VC funds. So this is an interesting survey. And it asks the GPs, if you could hypothetically sell a long-held asset tomorrow, how much of a discount relative to your original underwriting would you be willing to accept? So as you can see, 40% would easily accept 5 to 10% discount, and a solid 24% would accept an even higher discount just to return money to their LPs to increase the liquidity in their fund. Now, secondaries, you will, if you have followed my channel, have seen my series on secondaries. Please go back there. Remains a talking point. Doesn't matter who I'm basically having a conversation with. And just as a side note, PSG Equity led a $2 billion continuation vehicle, which is the largest in the US in 2025. So again, continuation funds, strip sales, all those kind of GP-led transactions are really leading the war, if you like, in finding exits, finding liquidity for those assets. Now, let's leave buyouts behind. Let's have a look at venture capital. I think the title for the slide really should be bifurcation of the venture capital space. So firstly, VC investment slid from a skewed Q1 down to 91 billion globally in Q2 across just over 7,000 deals. Now, a couple of more details. Funding cooled quarter on quarter, but is still up year on year. So globally, VC hit, as I said, 91 billion in Q2. That's down 20% from Q1. And whilst this may sound surprising, let's not forget, Q1 was heavily skewed by OpenAI's mega round. We're still up 11% year on year. It's the strongest half since the first half of 2022. AI took the lion's share of global VC, and I'll come back to that on the next slide as well. And then in Q2, an interesting data point, 1/3 of US VC dollars went to just 5 companies. And surely you want to know which 5 they are, but give me a second on that. So, as I mentioned, AI took 53% of VC money. AI share of VC funding in the first half of 2025 was 53% globally and 64% of total VC funding in the US. So again, I've mentioned that before, there really is that bifurcation in the VC space right now. If you're basically investing in AI, if you're a founder dealing with AI, you're basically operating in a complete different space than being a founder that does non-AI or a VC that invests in non-AI. So I think that slide shows that very nicely. Now, let's have a look at those 5 companies that basically collectively raised 1/3 of US VC dollars spent. Scale AI, Anduril, Grammarly, Safe Superintelligence, SSI, and Thinking Machine Labs were the 5 companies that attracted 1/3 of US VC dollars. Now, a couple of more key insights on VC and CVC globally. So IPOs are stabilizing. So we're seeing more IPOs. You saw the news around that. VC-backed IPO activity, while improving, is still not enough to really turn on the spigot with regards to liquidity. So we need a little bit more to get confident about a recovery with regards to money back to the LPs. Fundraising is still facing headwinds. So raising money in VC remains complicated. VC fundraising year on year in the first half was down 33%, and the median time to close lengthened, underscoring again tougher times to convince LPs to part with their dollars when it comes to VC. On the CVC side, CVCs remain selective. They are really concentrating their bets and, no surprise, mainly in AI. So about 22% of the deals done in the first half of 2025 involved a corporate VC. And more than 40% of those deals were in AI. So clearly the corporates are kind of feeling it that they need to stay on top of AI and want to stay invested in it. Thank you so much for joining me. It was a real pleasure. So I hope you enjoyed this Q2 summary. Please put your comments in the chat below, and I'd be happy to basically drive a little bit more the conversation. You may have noticed that I didn't touch private debt. Why? Because I'm launching a new series around private debt. So please subscribe to my channel if you'd like to be posted. Thank you very much.